Okay, so I think now is the time to hand over the mic to Fan Liang. Fan Liang, I see quite a few questions have come in. So Matthew, you're okay taking some questions, and the other panelists as well?
Yeah, that sounds great.
All
I'll do
right,
my very best.
great.
I'm sure you will. So we have got quite a lot of questions coming in now from the past two. And if anyone have any more questions, feel free to pop them in. So the first one we have is from Max. Max is saying that right now it's difficult to look into the future of technology companies. Warren Buffett himself has said that he's skeptical of someone who claims that he can look into the future of technology companies. And since the valuation of these technology companies depend on future cash flows, how do you determine whether a company is undervalued or not? If a company is trading at 30 times PE and the earnings will double in 2 years, then it's a no-brainer. But what if a company trades at 100 times PE? So I think it's open to the floor. So maybe Matthew, do you want to pick it up first?
Yeah, I can address that to some level. Look, it's a good question, and it's a tricky time, difficult time. But in my experience, it feels like, and this is sort of the third crisis that I've been investing in professionally. But even when there's not a crisis, for those who maybe are younger or haven't been doing this for a long time, it's always a difficult time. It's always a tricky time. I mean, everyone always says, oh, well, in this situation, there's this unique aspect, and so it makes it so difficult. But tomorrow there will be a new difficult reason why people are struggling to determine value. And a lot of times that's why assets, they say, there's this phrase like the equity market climbs this wall of worry. But really what's happening is that everybody's worried and concerned about a number of fearful factors. Today, I'm pretty sure actually, I don't know. In the US, we are pretty quarantined and everyone's sort of locked in their houses. And I think in many places in the world, that's the case right now. Some places have handled the pandemic better than others, but it's a very fearful time. But as vaccines roll out, as politics become a little different, as we evolve out of this economic recession and situation we're in, it's not that stocks will climb the wall of worry, it's that the worries will go away. And so then people will become more comfortable investing in risky assets. So because we have a concentrated portfolio, meaning because we only have to own 10 or 12 securities, we don't have to buy the 100 times earnings securities, and you don't have to buy them either. If you only have to buy them if you analyze them and see something that looks attractive. And so more what I'm looking for, there's two other little tricks I like to use. And basically, the first is to find a great business model and then look around the world and see where else it exists. Because you can find companies in different countries that maybe have really attractive economics, but in that local area, they haven't been fully appreciated yet. And in fact, we had a situation like that with JD.com. So a few years ago, Amazon was just taking off. JD.com was struggling, but their revenue was just growing enormously. They had a great business model, great businesses, and so it was very, very attractive. So you can look in other areas to find things that are trading for lower multiples. But also what I really like in it, you can see this just in the daily journal analysis, is I don't want to buy the 100 times earnings. Maybe it's just like the old Ben Graham issues. Like I'm not that open-minded yet. So what's more attractive to me is to find a hidden subsidiary with those business dynamics and economics inside some legacy business. So it's sort of camouflage or disguise. And at some point there needs to be a catalyst, or maybe there's a spin out or something gets released to let that sort of shine. And so that's, I don't know, that's my answer. I avoid the ones trading for 100 times earnings usually, unless I can really find something that strikes me. And that's just how I handle it personally.
Interesting. You talked about JD.com. You know, I know there is a pretty significant amount of JD.com wealth in this Zoom call, because that's a question. That's a company that we analyzed in absolute great detail. And again, coming back to research, I mean, that was the time when the JD stock price, I remember, was like going down every single day, and we kept buying simply because we understand the nuances of the business. I mean, we realized that if someone looks at their the fact that they were growing their gross margins and all those things were visible to everybody, but if you look slightly in detail in their cash flow statements, we realized that even their change in working capital was large enough to pay for their large capital expenditures, and they were, the kind of moat they were building, it's unbelievable. So, even if you completely ignore the several businesses which they have, spun off, like JD Logistics, JD Health, JD Technology, I mean, again, one amazing business. And I'm sure there are several happy investors who have been buying even around 1920 and stuff like that. I think right now it's around 95. All right, so what's the next question, Panyan?
Follow Matthew Peterson at his website and YouTube channel with the links included in the video description below. If you have enjoyed this video, please smash the like button below and subscribe to our YouTube channel. Join our investment forum at Facebook. Link in the description below.